Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
Yeah, no, I mean, if there's one thing that I can say about the accounting industry is that it's one industry that's always adapting to the changing times.
Absolutely.
The accountants are adaptable, and so is the M&A industry, like you rightly said. I mean, more or less, the structure still remains the same. There's always a buyer, there's always a seller, there's always this NDAs, confidentiality, there's always a letter of intent, due diligence. The steps are the same, but the way it is done, the nitty-gritties of it, that has changed a lot as the times are changing. You're right. And, when we talk about due diligence, I don't really want to talk about due diligence per se, because that's a very, very complicated topic.
Mhm.
But if everything were to go well and they're like, all right, fine, the valuation is good. Now a peek behind the curtain, the due diligence process is going on. And you have been into so many transactions, so you could probably shed some light on this, that, what are some common red flags that you see buyers uncover during due diligence, which aren't really like red flag per se, because there's something that can be, they can be taken care of, or they could have been fixed ahead of time, something like that.
Right. Yeah. Some of the common issues that arise in due diligence is client churn, where they've got a revolving door of clients, and maybe they uncover historical data that shows a downward trend in revenue over the last couple of years. As it relates to personnel, it causes buyers to pause oftentimes when they see a census or a roster of staff that has an average term of employment of a year or 6 months, right? What's wrong in the culture of that firm that they have this employee turnover that keeps happening?
Welcome back to another episode of Accounting M&A Insider, a show where we dive into all things mergers and acquisitions with a focus on accounting and CPA firm landscape. I'm your host, Saul. Today's episode is an absolute must listen for any firm owner even thinking about selling in the next few years. Joining me is Todd Steinberg, founder of Thrive Financial Group. Todd has been guiding accounting firm owners through successful sales, succession strategies, and buyer negotiations for nearly 3 decades. We're thrilled to have him walk us through the checklist of everything a firm owner should be doing to maximize the value and readiness before they go to the market. Todd, welcome to the show.
Thank you, Saul. First and foremost, really appreciate you and your team having me on as a guest today. It's my genuine hope to be able to share with some of your listeners and your audience just really my unique lens of what I've experienced over the last 30 years now in helping accountants build, buy, and sell practices all across the United States.
Absolutely. Absolutely. Before I jump on and get you in for the first question, I just want to let all our listeners know that this podcast also qualifies for CPE credits. All you got to do is just hop onto my-cpe.com/podcast, and you will have this podcast there for you to listen to and also get your CPE credits. So make sure to tune in there. And if at all you're not able to go onto the website, you can always download our MyCPE One app, which is available on Android and iOS both, and listen to this podcast on the go. And with that, Todd, let's start with the big picture. All right. What are the biggest mistakes that you see firm owners make when thinking about selling?
Yeah, so there's a few, but if I were to narrow it down to what might be, I think the most common mistakes is that emotion oftentimes can get involved
Yes.
in what you're trying to accomplish. And I haven't met a seller in my career that doesn't want to have a really soft landing for not only their clients, but also their staff, if there's people that could be going along with the transaction. So trying to find the balance of the right economic package and the right deal structure, and also what are my people going to like? What are my clients going to like? What is the best culture? How is all that going to work together? And then ultimately, how am I going to be able to monetize what I built over the last few years? So I think just sometimes really stripping back the layers and figuring out when I'm talking to a seller, what are the most important things to you as we get into this process and we
Right.
start talking with prospective buyers? What are some of your core values? Is it top dollar and top terms? Is it best possible fit? Is it geographic location? Is it a firm that you could stay on and work with for the next couple of years? So it's not one size fits all, but I would say that's probably one of the bigger challenges that firms face is try to figure out, okay, how am I going to really feel about this transaction? And if I were to take some of the emotion out here, what's going to be best all around?
Well, I mean, like, I couldn't agree more with what you have said. And, when I talk to people or who are actually looking to sell their firm, they often are confused because they're not really looking at selling, but they're thinking about selling. That, okay, somewhere or the other, somewhere I'm going to get there. Exit planning per se. But then, they're like, so they ask me a question and I usually don't have an answer to it. The question is, how far in advance should someone really begin to prepare for selling their firm?
That's another very good question. So I do a lot of succession planning with
Right.
firm owners that are at various stages, some of which they are literally waving the white flag saying, get me out of here. This past tax season, this was my last, I'm done. And then I have other conversations with people and firms that are maybe 3 to 5 years away from wanting to sell their practice. And the day that you sell, what I think is important to keep in mind for anybody who's considering this at some stage in their practices development and in their own careers and personal lives is that the day you sell is not the day that you ride off into the sunset, never to be seen or heard from again. Typically, most of the deals that we structure as a broker for our clients, the buyers and the sellers, involve some level of a retention clause. Like, think about this. If you're a buyer and you're acquiring goodwill, which is really the main asset here, you, in most cases, don't have a problem paying for the clients that are retained. But if those clients don't stay, well, you've got a pretty good case as to maybe why that purchase price should be adjusted downwards. One of the best things that a seller can do to protect themselves and ultimately make it feel more like a merger than an acquisition is to stay involved for a year or two. And that doesn't mean that it needs to be at the same level of 2,000 hours a year. It could be really scaling back, whether it's part-time or maybe just doing the things in their business that they actually enjoy and getting out from underneath the things that they don't really enjoy anymore. And that might give them a new lease on life if ultimately they feel energized now to do some things that are really what gets them excited and gets them motivated to come to work every day. So I think at least a year or two at a minimum, be prepared to staying involved in some level. If you want to stay on beyond that, most buyers or firms that are acquiring today would be delighted to have you or your partners sticking around in some capacity. But I'd say at a minimum for a year or two, not only to ensure a successful transition and a very seamless merger of the two firms, but ultimately to protect your purchase price as well, because after a year or two at that stage, it's our belief that the responsibility really shifts from the seller to make sure that those clients transition to the buyer to now it becomes the buyer's responsibility to actually do a good job and serve those clients. And now the seller has options. In a year or two, they may decide, you know what, I'm going to stay involved for the next 5 years if they're happy, or they may decide at that point, you know what, it's been a good run, but it's time for me to do something else or retire.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Okay, well, that makes sense. So, I mean, like, I was hopeful to, like, get a perspective into it, because this is something that a lot of people have, that I'm not really thinking about selling now, but eventually it will come to the point wherein I will have to sell, right? So I'll need to be ready, because you hear the things that, the firm needs to be at a certain level. It needs to actually have some things that the buyer will actually look into. So when somebody says that the firm, when a buyer, when you reach to that point where you tell to the firm that, okay, now your firm is ready for selling, what does that actually look like from a buyer's perspective?
Yeah. So, the saying, beauty lies in the eye of the beholder. I think that's very true for accounting practice acquisitions. And I'll give you an example. I had two practices recently. One of them was a $500,000 practice in which it was a sole owner. He had a very lean organization, meaning he had no physical office space. He had maybe one or two staff members that assisted him. Highly profitable, but they worked a lot of hours, right? So good
Yes.
profit margins, good average fees. So some might look at that practice and say, okay, well, they're very, very profitable. That's a great firm. On the other hand, I had another very similar, in a similar market, $500,000 in revenue. They had a Class A office space. They had four staff members. The owner worked part-time. They had the finest software. They were really doing a lot of things right, but their margins, because their expenses were a bit higher, mostly human capital, but they also had a nice business, and their margins were substantially less than the other firm. So I guess my question would be, which firm is more valuable? Is it the one that has the higher margins, where the seller's working a lot of hours and they're running lean? Or is it the firm where they've got a team, but they can delegate, and they've got an established process in which the owners built a business around them? I don't know that there's a right or wrong answer there. I just know that to some of the buyers that I'm talking to, they want the most profitable practice. I have others that look at, okay, if I'm consolidating some of these expenses into my existing practice and I no longer have to maintain that office, and I have been searching for good talent, they've got four good people on their team, they might view that human capital as much or as important as bringing in the clients themselves and the revenue associated with that. So I think sometimes it's a little overstated that you need to do all this restructuring to make your practice more attractive to the masses. Sure, there's steps that you can take today to make it more profitable if ultimately that's your end game. But who am I to tell a CPA, look, you can't take 9 weeks vacation anymore. You need to work 60 hours a week. You need to go do this. I'm not so sure that firms are are excited about doing things like that. Now we can look at things like outsourcing. We could look at things like reinventing ourselves to offer other services. And that's a different conversation in terms of sort of evolving into what a 21st century accounting firm would look like. But as it relates to cutting expenses and making wholesale changes to the practice, predominantly firms are still trading for a multiple of top line revenue and sales. So as long as that's the case, I think it's more about what you're doing on the top line than it is what you have coming into the bottom line. That's not to say that that's not important, because financing, cash flow lenders are going to want to make sure the business is going to cash flow. But a good buyer can kind of see and do a projection and say, all right, we can make some changes and really leverage technology and leverage our team to be able to run this business potentially more profitably than what it is today. So all that to say, it really is dependent on the situation, both on the seller side and on the buyer side.
Well, Todd, I cannot thank you enough for sharing that perspective, because that was the much needed perspective. Because mostly I see people advocating that, if you're going to be acquiring a firm, you want to acquire a firm in which there are lesser owner hours. That's what we see happening. But I mean, that's what we see people saying, that this is what you should be doing, because when you're acquiring a firm, you don't want to do the job that somebody else was doing. You rather want to just acquire the existing business, well-oiled machinery, and it just keeps on going. The talent is retained, talent retention is value retention and all that. But I like your perspective of how you said it, how you brought that forward, because what's in it for the buyer, that makes a big difference, right? What is the buyer looking for? I guess that's really interesting. And
I
when
think it's just important to note, if I can, that we're talking about small to mid-sized firms. Like typically the practices that we represent here at Thrive are anywhere from 500,000 to 5 million. So this doesn't apply as much maybe for a $20 million regional firm or a large firm. For any of your listeners that are wondering, okay, how does this apply to a larger accounting firm? I think it starts to get it starts to become a little less relevant as you start to get a little larger.
True, true. I couldn't agree more. Well,
Good.
I just want to like shift the gears to a little bit, because I know that, we don't need to do like a lot of things, but still, when you really get into it, when you get into the weeds of that selling part, when you go into the selling part, uh, what financial documentation needs to be in order before going to the market?
Yes. So what needs to be in order before we go to market? So there's two layers to this. The first layer is what I'll call the generic layer, which is what does a broker need to be able to advertise and promote the practice?
Right.
And that is very general information, maybe the vicinity in which the firm is located, what city or county, if we want to be a little less specific, if it's a smaller area. We don't want any identifying factors that are going to allow a prospective buyer seeing it on the internet to be able to say, oh, I know that firm around the corner. So just things like revenue, client mix, what type of software you use, average fees, those things we should be able to put together in a basic questionnaire to then be able to market the firm. Once a buyer has signed a non-disclosure agreement and provided some level of a resume or buyer profile or website possibly, and showed evidence that they're financially qualified, whether that's a personal financial statement or in some cases a pre-qualification letter from a lender that they may be working with to go get bank financing from. Once we vetted them and they passed the initial sniff test, then at that point, it would be an information disclosure that would involve, and what the seller really needs to begin to pull together is make sure that they've got accurate financials, both year to date, prior year, and they also want to start to get together a list of any fixed assets that they might have, if ultimately that is going to be sold separately or if they're going to include it in the purchase price. Lenders, if we're going to require bank financing, and many of the transactions that we're involved with, the buyer is going to go get a loan for between 80 to 90% of the purchase price. They might put an equity injection in of 10%. Maybe the seller holds a note for 10%, which is typical terms in today's small to mid-size. This is how they're trading for the most part. So if that's the case, the bank's going to want to see the last 3 years tax returns. They're going to want to see, as I mentioned, the financials year to date. They're going to want to see the prior year financials. And in some cases, they're going to want to also have information that would entail like industry of the clients, like a redacted client list almost that doesn't show names, but shows if there's any particular niche, industry, and what services they're providing those clientele.
Wow. Wow. In fact, I was having a conversation earlier today wherein, he said that, during the conversations, I usually ask them that, okay, what's your average revenue per client? And, he's like, I don't know what's my average revenue per client. And he's like, all right, here's a simpler way to say, are you charging, what are you interested? Tax return. All right. Do you do business tax returns? Yes. For that client that you do business tax returns, how much are you charging? This much. Is that the only payment he does in the entire year? Yes. And that's your revenue per client.
Yeah, it's funny. A lot of times when I say, if you could please send me your year-to-date financials, they've got their clients' financials up to date, but their own financials, they're months behind. So understandable coming out of busy season, but it's important to have that information handy. It's just, at what time do you really begin to disclose some of those documents, even with a non-disclosure that might be signed? You still want to make sure that you're just not firing off all that financial information to every inquiry that
Yes.
open to learning more about your business. It's really only once we vetted them and everyone determines that this looks on the surface to be a good fit, would that information ever be disclosed to a prospective buyer.
Yeah, yeah. So that would be the generic information. And then,
Right.
once you get into the weeds, then there is this additional things that you gotta
Due
share.
diligence comes typically after a letter of intent has been agreed upon. So we don't want to get into these extensive information requests when at this point, we really don't even know whether they're going to make a fair offer. If that offer is fair and it's accepted, then we'll pull back the curtain and we can show the prospective buyer pretty much whatever they want besides
Yeah.
a client list.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Absolutely. And when we're talking about when it comes to selling, the synonymous term is valuation, because at the end of the day, it's the valuation that drives everything, right? And with small and mid-sized firms, revenue multiple or EBITDA multiple, that could also be there. I mean, that affects it. And then we have something called the adjusted EBITDA that a lot of people don't quite take into consideration, but that's something that really affects it. And I'm seeing that, what this also certainly goes back to the owner hours point that we had spoken about. And that, the owner's perks, the perks that the owner is taking out of the firm, that how does that affect valuation? If we could shed some light on that.
Well, if we have add backs, this is why oftentimes as a broker that represents the sellers, I like to use a multiple of revenue, because when you start to get into EBITDA, SDE, and believe me, firms are being valued that way. And it's not that I disagree with that valuation, but when you start having add backs and owner perks and other things, it gets a little complicated. For the longest time, it had always been a multiple of revenue, and that range would be anywhere from 1x on the low end to maybe 1.5 for a really high end, super efficient, great location, super profitable, great client mix. Most of them are in the middle at about 1.25. And I think that still rings true today, although I am seeing in recent years, the valuations are becoming a little higher and a little higher and a little higher over the last few years. And a lot of that's because of the interest that we're all hearing about in this profession from outside investors, institutional investors, private equity groups. So it is driving the valuations up because it's competitive and there are multiple buyers bidding for these firms. I do see methods now where people are using 3 to 5 times SDE or EBITDA valuation tools. So, we can look at that as a factor as well. And we have had a few firms that are trading at 2 times revenue now and 1.75 times revenue. So kind of what was going on over the last 30 years I've been in this business, there's been more change in the last 2-3 years than probably the first 27 years combined. So it really is an exciting time, especially as it relates to valuations for firms. So things are continuing to creep up in terms of the valuations on the high side. It's continuing to surprise even me.
Yeah, no, I mean, if there's one thing that I can say about the accounting industry, is that it's one industry that's always adapting to the changing times.
Yeah, absolutely.
I mean, the accountants are adaptable, and so is the M&A industry, like you rightly said. I mean, more or less, the structure still remains the same. There's always a buyer, there's always a seller, there's always this NDAs, confidentiality, there's always a letter of intent, due diligence. The steps are the same, but the way it is done, the nitty-gritties of it, that has changed a lot as the times are changing. You're right. And, when we talk about due diligence, I don't really want to talk about due diligence per se, because that's a very, very complicated topic.
Mhm.
But if everything were to go well and they're like, all right, fine, the valuation is good. Now a peek behind the curtain, the due diligence process is going on. And you have been into so many transactions, so you could probably shed some light on this, that, what are some common red flags that you see buyers uncover during due diligence, which aren't really like red flag per se, because there's something that can be, they can be taken care of, or they could have been fixed ahead of time, something like that.
Right. Yeah, some of the common issues that arise in due diligence is client churn, where they've got a revolving door of clients, and maybe they uncover historical data that shows a downward trend in revenue over the last couple of years. As it relates to personnel, it causes buyers to pause oftentimes when they see a census or a roster of staff that has an average term of employment of a year or 6 months, right? What's wrong in the culture of that firm that they have this employee turnover that keeps happening? Conversely, if you have a group of staff that have been there 5, 10, 15 years, that says the opposite, that this is a good firm culture. So I think those are probably the most common things that I see, that in some cases we can be worked through. In other cases, it revises the terms and the deal structure, or in some cases, the buyer decides to withdraw their offer altogether.
Now, well, thank you, Todd. I recently did the private equity webinar, and in the beginning of the webinar, I asked them that, when you think about the word private equity, what comes to your mind? And one of the participants said layoffs. I was like, no. I mean, we did bust the myth during the webinar, but we always hear that, people make the firm, right? How important is that in this next level leadership team in a deal?
So, great question. A few years ago, when I was being bombarded by private equity groups that were looking to get their foot in the door in the industry and start to acquire practice or practices, I was skeptical. My first thoughts is layoffs, is trying to make it as profitable as possible. What's that going to do to firm culture? Are jobs going to be lost? Is it going to be all about a quick flip where they buy them, consolidate them, and then flip in 2 to 3 years? And what's been really surprising to me in a good way is that many of these private equity groups that have had success, that are now fast forward 2, 3 years, they've made several acquisitions. And in fact,
Right.
many of them have made north of 15 or 20, again, small to mid-sized firms, in which
Yes.
now they've learned a lot over time, that this really is, to your point, all about the people. It's all about the clients. It's all about the staff. And it's all about creating a good workplace and a good environment and a good experience. So when I now have several private equity backed buyers, and I hate to even call them private equity because today they're accounting firms. They're in many cases top 100 accounting firms that have a platform, that have rebranded, that have 500 team members, 70 CPAs. It's hard to call them private equity anymore, really,
True.
even though they're private equity backed.
And that's
So
what I was going to
uh,
say. They're backed by
yeah,
private.
so I mean, and there are many that are still coming into the industry looking to get their first or few acquisitions. I prefer to work with those that have already made their way, and now that there are plenty of them, whether it be firms that I've sold to these groups or maybe another broker has worked with them directly, there's many of them now that are doing a great job out there. And believe me, as the broker, I would be hearing from the seller if things didn't go well, and I've heard nothing but great rave reviews in almost every case, that it has gone extremely well. Now, the jury's still out. Talk to me in 2, 3, 5 years, and we'll see how everyone's feeling at that point. But at this stage of the game, I think it's been a great thing for the industry. I mean, you really stop and think about it. Accounting firms, for whatever reason, have traded at lower multiples than other industries for a long time. And because we're somewhat recession proof, because we are in many cases the most trusted advisor to our clients, it's natural now why a lot of these groups are coming in. They realize that they've got a huge opportunity to go in and provide the compliance. And now we can be their trusted go-to for all things forward-looking, wealth management, advisory, family office environment type services.
Yeah.
And this is what many of them are doing, is they're adding different spokes to the wheel to be able to become a full service firm and competing with some of the top 50 or 100 firms out there in the United States that were kind of built more brick by brick. In this case, they're buying them up with a lot of money behind them.
Well, the only way is up, and that can only happen through this acquisitions and diversification of services. So rightly pointed out. But this is the topic that I always like to hear opinions on: owner hours. Right? It's a topic. It's debatable, no doubt. But owner hours, we covered it in that example that you gave earlier. But Do buyer impressions shift based on how many hours the owner is still billing or working?
So depends on the buyer. If
Yeah.
it's a buyer that has been working for Big Four or in private industry and they're ready to jump in, they're taking out a large loan. They've got to be able to afford the debt service. They've got to be able to make a reasonable living. They may not be able to afford to pay the seller to stay on and work, a 1,500, 2,000 hours. Just really depends on the size of the practice in that case. If it's a
Right.
firm that is more of an investor type group and they don't have that person waiting in the wings to step in, well, they might really love the concept of paying that owner or the former partners, the sellers, for 3 to 5 years, even if it's a handsome salary, to be able to buy some time to be able to find their replacements.
Right.
So, depending on who the buyer is, that can be looked at a little differently. And selling small to mid-sized firms, I'm dealing with both. I'm dealing with firms that are consolidating smaller firms into their larger practice, and I'm also dealing with people that are coming out of industry or trying to start practices. And in their case, it's a cash flow issue, and how busy do they want to be? I would say this in summary and final point on the topic, that most buyers would be delighted to have the seller stay on for a period of time. Very few times do they want them to, like, give me a month of transition and then that's it. They do want involvement, but there's a wide range of what that involvement actually is defined as.
Absolutely. No, I completely agree to you on that. And I guess even from an owner standpoint, that should be, even from a seller standpoint, that's a good thing to look into, because you have built a business for a long time. So it's natural for you to be emotional, to make sure that, whoever is going to be the new owners, your clients are taken care of, your employees are taken care of. And if you're going to be involved in those transactions to make sure that that hand holding was perfect, it's a very positive thing for everybody.
That's right.
So
People don't like change, and if
yeah,
we're there to make it feel more like a merger, and then the seller phases out after we've had a chance to make that new owner build relationships with clients and with staff, then it generally is a lot more successful in terms of both retaining staff and clients.
I agree to you, man. I agree to you. Now, let's talk about clients. Those are the
Sure.
ones that bring in the money, right?
Yes, they do.
So, what makes a client base attractive to a potential buyer?
Right. So when I value a firm, there's four main factors that I'm looking at: location, profitability, staff, and client mix. And client mix is probably the one of the biggest, if not the biggest one, that carries the most weight. So typically, when there is more of a accounting, bookkeeping, compilation mix, because of the frequency of the relationship, because that work can be in many cases delegated, whether it's to a team member or to somebody, offshore or onshore, a third party. I don't know about you, but I like to get paid every month versus, an annual transaction. So monthly or quarterly clients are highly regarded. And I would also say live payroll, for many of the same reasons, even though it's complex and there's liability there. A lot of people are willing to pay a higher premium for payroll practices. So bookkeeping, payroll, very strong. If one does advisory services, also trading for higher multiples. I'm not talking about like wealth management. I'm talking about meeting with your clients on a regular basis, monthly, quarterly, and charging them
Excellent.
a fee. Yeah. So, and we all know that that's a hot area and has been for the last several years now in our industry. Um, Income tax. I mean, look, there's an opportunity there depending on the average fees, but if the work is spread out throughout the year, if it's good clients and the fees are good fees, like right now I have a listing. One of my clients, their average tax return fee is $2,000 for a 1040. That's pretty good.
Wow.
And, they're very profitable. I have another client where their fees are less than H&R Block and Jackson Hewitt. And this is a CPA firm. So this is a challenge to, you don't want to come in and raise fees or double prices right out of the gate, right? Maybe over time, but not immediately. So I'd say, the client mix, working with business clients, is probably the most attractive. And I'll just leave it at that.
Well, but I think in that nutshell, you covered so many things. You covered about the frequency. I mean, how is the money coming in, the variety of the services that you have? Because you're right, and I guess that's one of the reasons why this attraction is there for acquisitions, right? Because there is predictability of income. That's one thing. The industry is recession proof, that's for sure. But how frequent is that money coming? That also makes a big difference. And if it's recurring, if you got advisory services, or if you got clients who are paying you maybe monthly or quarterly, that's a good thing to have, when the money
Yes.
is coming in regularly. It's a good cash flow to have. But
Absolutely.
and then this is something that some people have a problem with, when I tell them, because whenever somebody starts off, they start off in the regular compliance role. Tax returns happening once a year. The clients are coming in January to April. You're fully occupied with their tax returns, and you got all that going. You got good money coming in those 4 months. You're getting all those returns done. But then afterwards, for the rest of the year, you're not really that keen on the bookkeeping and all that. So the revenue is not really that consistent for those rest of the months. So it's kind of like the ant and the grasshopper kind of story, that you're working the
Yes.
4 months for the entire year.
And I have
But
some sellers love that. And
yeah,
it's like they work really hard and then it eases up and who are we to tell them that's not the right model? But as far as valuations are concerned, it's not the best. And income tax practice generally sell for lower multiples than accounting practices for that reason.
wow. Yeah, because accounting is more recurring, and it's regularly happening. Oh, interesting. Interesting. Well, Todd, I wanted to keep this conversation going, but I know that this is one podcast. We're having one more podcast happening, and I don't want everything to be covered in one podcast itself. So, before I let you go, if I were to ask you that, what's one thing someone could do this week, or maybe as they're listening to this podcast, what's something that someone could do as they're listening to this podcast to begin preparing for a successful exit?
Yeah. The advice that I would give to somebody is to think about your business like a CEO and
Right.
not necessarily as a CPA. And what I mean when I say that is that I talk to a lot of accountants who have built great businesses, but they're everything to everybody. And heaven forbid if something were to happen to them or when they're ready to think about selling their practice, if it is you needing to be replaced, that practice is not as valuable as one that has a team and can be leveraged and work can be delegated. So the way I think about it is there's two ways to make money. You can bill yourself out at a high rate and work a lot of hours, and you can make a lot of money. You've essentially bought yourself a job, but that's not a business. A CEO would say, how can we delegate? How can we leverage? How can we put the right team around us? And whether that's offshore, onshore, in-house, thinking about how you can step back and make that business turnkey as possible. It's not going to run on autopilot, but as turnkey as possible so that when you are ready to have a conversation with a broker like us, you've got a business that can run in your absence. And if for no other reason than if something were to happen to you and heaven forbid it's March 15th and now you've got a gallbladder surgery or something that's come up and your whole business comes to a halt. And I hear these stories all the time from sellers where that's a challenge. So I would say, let go of the control a little bit. And I know that's hard sometimes, but think about how you can be more of a business owner versus a technician.
Well, as this goes in lines with, like what I had covered with John Varilo in one of the prior podcasts, that, you want to convert your practice into a business, right? And that's what it is. So thank you, Todd, for reinforcing that. This has been very insightful. Now, before I let you go, how can people know more about you and learn more about Thrive Financial Group?
Yes, and thank you, Saul, for the opportunity. Really enjoyed the conversation today and looking forward to part two. So people can find me, the best way would be my website, which is Thrive Financial GRP, and they can see our current list of practices for sale if they're in the market to buy. And you're welcome to schedule a call with us if you'd like to begin to do some succession planning and learn what that process might look like for you and your firm. So again, thank you for having me.
Absolutely. Well, folks, whatever Todd has mentioned, I will have that also mentioned in the description so you have a direct link to it. And with that, I want to thank you, Todd, for your time and your insightful wisdom. And I also want to thank all the listeners for tuning in. Please continue to stay tuned in for part 2, wherein we'll cover more insights. Until then, take care. And as always, keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now